Welcome, everyone. We're going to go ahead and get started. My name is Hayden Harrington. I'm one of the managing partners at Momentum Multifamily alongside my partner and co-host, Dustin Miles. Today, we're excited to bring you our 2023 mid-year update. So we're well into the year. We really just wanted to share kind of what we're seeing, what we're hearing, what we think is ahead in this interesting times that we've got before us now. So we're going to jump right in and get into the presentation.
Okay, yeah. So Hayden kind of mentioned we'll go over our background, the market, mission and vision, and kind of give a summary. If you have any questions, we'll address those at the end. We do have a hard cutoff at 7 Central, just FYI.
And then just quick about us. So we're based here in Texas. We're big believers in the Texas markets. Dustin's in Fort Worth, and I am on the north side of Houston. So we've got a presence in both of our target markets. I'm originally from the Woodlands area, which is on the north side, and I know Dustin was born and raised in the Fort Worth area. So we are definitely know our backyard very, very well, and that's really where we're focused on. So here at Momentum, that's really what we try to do, is just to really stay in our swim lane. We want to stay on what we believe that we are experts in. We don't want to try to be an expert at everything. We want to do one thing really well, which is multifamily, and so that's what we're focused on. And we're big believers just in multifamily overall, and in Texas in general. We think that the future looks bright for both, and we are overall very bullish in the long term for Texas multifamily.
Yeah, so right now we have 178 under assets under management, and then our average cost basis is 155 a door. I do want to mention that 155 a door, those are all 2,000 newer products. We feel really good about that basis and where we're at. So currently have 1,143 units. And then as Hayden mentioned, our focus is Houston and DFW. I'm in DFW. Hayden's in Houston, and then we do have we'll kind of talk a little bit more about it, but I've owned in the past in DFW and sold, and looking to build a portfolio back up in DFW, kind of using very similar recipe that we've been working on for a number of years in Houston, and we've been able to tweak and get better. So we're always all about improvement.
Yeah, absolutely. And that's a great segue into meeting the team. So this is our current team at the Momentum level. Obviously, we got Dustin and I. Ruben handles all our construction. He's a partner on all our deals. He does passively, and he's a key principal on all our deals as well. So he's a great asset to the team. When I lived in Dallas, I actually officed with him as well. So we just built a great relationship over the last few years. And then we got Anthony Calanetta. He's our asset manager down here in Houston. So as we've expanded the portfolio to about 1,150 units down here, we've wanted to invest in our people early. So we brought Anthony on a part-time basis over a year ago. So we've been working with him very closely, and then he's actually going to transition on October 12th to full-time with us. So he's definitely a great asset to the team. He has previous experience working with Camden and Hilltop, two very, very large operators. So excited to bring him on full-time and oversee our Houston portfolio. And then we've got Sydney Beacon, who is our assistant, helps us with all of our back end, all of our back end stuff, and dealing with day-to-day tasks to help keep us organized and all headed in the right direction. So just really grateful for the people that we have, and we're excited to continue to invest into our people, because we believe that that's the foundation any company is built upon. So really just excited to continue to grow and expand our team and expand the portfolio along the way.
Yep. So, like we mentioned, focus is DFW and Houston. We're not the group, not looking to buy all over the country. Just really want to focus on where we know. I invest passively and all that. I know when I'm looking at, once I feel comfortable with the operator, I'm looking at the location pretty darn hard. And you can put all this money into a property, but at the end of the day, you can't choose your neighbors, and or can't change your neighbors, and can't change your zip code, can't change your school. So it's really about locations. And so we're very comfortable and well versed in both these areas.
All right, now we're going to get into the market. So we're just going to touch on some stuff that we're seeing and what's projected ahead. So Dustin, yeah, if you want to kick us off there.
Yep. Yeah. So in general, I guess I'll, kind of teasing them with the slide a little bit, but, these are just kind of, average rents over time. Right now, the market's, tougher. It's, we tend to think of everything like a pendulum. So, you had these super strong rents, not sustainable by any stretch of the imagination. You had 15-20% rent growth, which is not no one can keep up with that. So we've things have tempered down a good bit. But there's still going to be rent growth and all that, and we'll kind of look in some other slides as well. But there's quite a bit of supply came on, but due to higher interest rates and all that, as you're seeing in the single family market, there's not a ton of single family moving around and all that. The supply is very tight. And that's due to the higher interest rates. Well, the same thing is happening on the construction side as well. People, the construction folks are having trouble, getting loans, or if they are, they're like, does this make sense? And so, you're seeing multifamily starts are really, really coming down quite a bit. So, Hayden, anything else you want to kind of mention to this?
Yeah, I think there's a couple important things with this graph. It really highlights just the overall broad trend of apartment rents over time. So over the past 20 odd years, rents have essentially tripled. So overall the rents have continued to climb. Like Dustin said, there was that period between 20 and 21 where rents were rising rapidly, as you can obviously see. It was not only Texas, but it was everywhere across the country. And now, it's definitely tempered down. You can see that we're not on as steep of an incline anymore. But I think the important thing here is to look at, we're still projected to be on an incline overall. So I think that's a good thing to take away from this. We are seeing just across Texas in general, we're seeing some softening. But overall, the inability for people to afford houses and the delta between cost to rent and cost to buy widening so much is going to help support average rents, because that gap between owning and renting has only increased tremendously as the Fed has increased interest rates. So overall, I think that's going to be another factor that benefits rents in the long term, and what's going to support healthy rent levels over the next few years. All this data is courtesy of RealPage, so they've got more data than anyone else into what's going on at the apartments across the country. So we follow them very, very closely, and specifically the markets that we're focused on. So obviously Dallas, Fort Worth, and Houston are our targets. That's what we really want to pay attention to, not only at a macro level, but also a micro level when we're drilling down into submarkets and so forth. But overall, we take this as an encouraging sign. I know we've definitely got some headwinds out there, not only interest rates, but also just operationally from insurance and taxes and those sorts of things. Being in Texas, Greg Abbott's been doing some great things. He's been an advocate for lower property taxes, which just got pushed through, and that's gonna hit our bottom line actually, because a large portion of that was to reduce the rates of the school districts, and that's when you look at a millage rate for an apartment complex, that's actually the biggest percentage of your overall tax rate. So that's going to be beneficial, and we've actually talked very closely with our tax professional. We work with Cantrell out of Dallas there, and they've told us over the next 5 years those rates should continue to go down, which will help. Obviously, you still got to fight the counties on your assessed values and litigate when you need to, but as long as you're being proactive and working with your tax professionals, we are seeing some successes on that front. And then on the insurance front, which I know everybody's been talking about, especially in Texas here, as long as you're being proactive, there are solutions out there. There are ways to win. Some people are just hoping the renewals come in where they're currently at, and not taking any action outside of that. And we think that is the wrong approach. Our renewals came in very high, but we were proactive about shopping it. And our average across our portfolio actually, because we had to shift carriers, but overall our average I don't even think went up at all. And in one case we got a rate that was actually better than the seller had when we bought it. So overall, there are options out there. Across our portfolio, we're at $700 a door. Buying newer product does help. So again, that's part of our shift to newer, especially in this part of the cycle where we're at, where the interest rates are forcing cap rate expansion to a degree. And most of that is being felt on the C class. The older vintage properties are seeing the most expansion there. So obviously, anytime you have cap rate expansion combined with an expansion of your expense ratio too, now you're getting hit from both sides, and that's going to make things that much more challenging. So again, why we're focused on a little bit newer properties in the suburban areas too, that's what we really like. Because those are typically of when you look at a metro too, those are typically the more affordable areas of the metro. You go downtown to the urban core, your rents are going to go through the roof. So as we're entering periods of consolidation as well, that's another thing to consider. Not just where are people migrating domestically in the at different parts of the country, but what about at that metro level as well? You might see people moving out of the urban core into the suburbs for the ability to lower their overall cost of living. So that's where we like to play, both on the newer asset side, in areas that are generally just affordable for the majority of the people out there.
Yeah, and I think a lot of you guys have seen a lot of the data out there. Houston and Dallas, have been and will continue, at least projected, to lead the country in terms of population growth and job growth and all that. Fortunately for us, we just happen to live in DFW, and Hayden lives down in Houston, so very, very fortunate there. But also want to kind of tag on a little bit about what Hayden had mentioned in terms of the shift from older product over to newer products. So kind of our recipe is kind of 2000 newer in Houston, and we're all out in the burbs. We're mostly on that north side, and that was on purpose. We wanted to be away from the coast, kind of for insurance purposes, really. And then we've been fortunate that we've been able to kind of cluster a few things together to where our asset management is just super easy. Within 20 minutes we have 850 units. So it's a super easy, just from an asset management perspective. And that's another thing is too, we were very big on, obviously I'm not able to touch the properties every week because I'm in DFW, but Hayden and Anthony, between the two of them, are able to touch the properties every week, and that's really important to us. We believe, what you focus on grows. And so that's just one very important piece of the puzzle. And then if we were spread out all over the country, or even if we were in secondary markets, or because obviously Texas is huge, we wouldn't be able to touch the properties every week. And so we do hire a third party management company. We work with Asset Living. Our regional is only over our assets and no one else's. And so, if we're kind of buying everywhere and all that, we just, we like the fact that, so the regional is another set of eyes, but then we're kind of, we come in, at the same time or behind her as well. So just lots and lots of eyes on the property, a lot of accountability. And so that's just, that's really important to us. But yeah, so those are just a few of the things. But also wanted to mention, as far as that shift to newer products, so you have when the thought process originally was like, oh, we'll kind of shift, because at the time it was COVID, and we're like, okay, we'll do kind of more white collar, gray collar, just because they can work from home and we wouldn't have to worry about, if there was another kind of shutdown or anything like that. Hopefully that there won't be. But kind of another side benefit of that, a lot of the newer product, especially more so than the C, the B product, there is some expansion, but not as much. But the exit cap rate expansion, and we're seeing that right now, right? So we've had some expansion. Depends on the metro and the whether you're urban core or suburban, but you've had some expansion on the A stuff, but some of that B and especially the C, you've seen quite a bit more. And then we're seeing fortunately now on our end, insurance is hit very differently. If you have a C class property versus a B and A, insurance is a very different thing for C class properties. So, anything else you want to mention here, Hayden?
Yeah, I just like to reiterate that point. We talked really closely with our insurance broker, and so a lot of our focus is guided by just keeping up with the experts in the markets. And one of the things when we talked with our insurance broker was, if you're along the coast, for example, there's really nothing you can do to prevent higher insurance costs. And so no matter if you've got a very nice property or not, I mean, there's just a lot of carriers that won't touch it. And so you have to layer on carrier after carrier, and it gets very expensive very quickly. And so we listen to that, and we take that advice, and anytime there's a deal, even if it's a nice deal on paper, if it's in an area that we're not comfortable with for whatever reason, whether it's, to Dustin's point earlier, if it's down in San Antonio and we don't have a presence there, or if it's up in Oklahoma or North Carolina, we won't look at it because we don't have a way to efficiently operate it. Or if it's on the coast and we know that insurance is going to be terrible and there's going to be no good options there, we don't consider it. So, taking all these variables of risk into account on the front end, I think is super important. And I think one, just to hit on to Dustin's point of, just how do you operate post close? I think especially now is something everybody should be asking. And moving forward, I think that should be, whether times are good or bad, the primary focus prior to getting into a deal is, how do we operate this thing after we close on it? Because anytime there are economic headwinds like we're facing now, it just it magnifies those challenges. And so if you can try to minimize any risk on the front end, that's going to make your life much, much easier as you go and operate these. So we're very conscious of, where properties are when we're getting into. Not only do we want to we want to love that location, but we also want to say, well, what if we get into it and we need to pull a staff member from one of our other Henry properties? Can we do that? Is logistically, are we close enough to be able to do that? If it's an hour and a half away, there's no way that's going to be possible, let alone another metro away, 3-4 hours even. So we're always thinking about that. And I think that's something that, everybody should take into account, not only when you're investing, but also if you're looking to buy these projects on your own as well. Just how do you get to these? I mean, these are, so the picture here is the Henry at Rosenberg. It's a 184 unit community in Rosenberg, Texas. And, that's a lot of families that live there. A lot happens week to week. And, you've got to be able to deal with everything that comes up. People are interesting, and you got to love them, but you're going to deal with it all when you're managing these assets. And you got to not only be willing, but close enough to be able to get out there and solve problems when they pop up. So I think that's super, super important, regardless of what the economy is doing, to just pay attention to those factors. But especially now, that's a huge element of risk that can be removed by just, buying wisely on the front end.
Awesome. So we were kind of hinted at this a few slides ago. So this is a supply slide, obviously. So we're Dallas has a little bit more to go. But Houston's very close to that peak, Fort Worth as well. So, and then as you can see, the supply really tails off here pretty quick. It takes a time to build. It takes time for the permitting and all that. So a lot of people have pointed to, and no one has a crystal ball exactly, but otherwise they would have bought a bunch of cap rates or rate caps and done well a few years ago. So it'll be interesting to see what happens. But to Hayden's point earlier, once that supply falls off and once potentially some of the headwinds start to cease, it'll be pretty interesting. It's supply and demand, and so it'll be interesting to see what happens in terms of rent growth. I think we'd mentioned earlier, but we kind of see a lot of this stuff as a pendulum. So if you think about just all of this, if you think about COVID, we went to one side, right? Everybody was indoors and no one was spending money. They were all saving money and the government was giving people money. And then you saw everything swing the other way and everybody was out buying, everything for a while. And it feels like we're, I don't know, what that pendulum looks like coming back, but it feels like it's tough to buy a house right now. There's no homes. I've been trying to buy a house, and so it's been there's just not a whole lot of it'll be interesting to see what that looks like kind of swinging back. But we did have the biggest rate hike, at least in the more modern era, and so that'll be interesting to kind of see what that looks like over the next few years. So anything you want to add, Hayden?
Yeah, I think just a couple important things on this slide specifically to note. We're definitely bullish on all three markets here: Dallas, Fort Worth, and Houston. We think they'll all do well in the long term, and we like that back end trend. Once all the supply falls off, I think that's going to benefit all of the markets in terms of occupancy and rent growth. In the near term, I think there's a couple things that this graph tells us. I think for Dallas, it just says, be careful where you buy. Make sure there's not too much supply coming online, because especially when you look at Houston and Dallas, they're very similar metros in terms of population and job growth. And we'll actually show another slide about how they kind of stack up. But so you've got similar amounts of people moving to both metros, but you have almost twice the amount of supply coming on in Dallas. So obviously that's going to be very focused on certain markets or certain parts of Dallas. Like I know up north, like Frisco, McKinney area, there's tons and tons of building going on right now up there. So obviously not all submarkets are going to be treated equally in Dallas, but this just shows that there is a lot of supply coming online in the near term, which may provide opportunity as well, where you may have developers or you may have deals that were bought a couple of years ago from a developer. Maybe they had some challenges and they battled all this new supply coming online, and they're just getting hit with all these different headwinds, interest rates and expenses and so forth, and maybe they need out. So I think there'll be opportunity that comes of it, but it also presents potentially a challenge for Dallas in the near term, just with that amount of supply coming online. Houston, obviously we're bullish. We are building our portfolio there. Definitely like the fact that we're almost to the peak. And then the other thing that we really like too is supply levels after the fall off actually go lower than pre-COVID. So we find that very interesting, both for Houston and Fort Worth. You'll notice that they fall off to levels that we haven't seen prior to the pandemic. So I think that's super interesting for both Houston and Fort Worth. Again, just to reiterate, we like all three markets, but we take this data and then we say, okay, with Dallas, that is something to be aware of, that there's just a lot of supply coming online. So pick your deals carefully. A well-located B deal in Dallas might be a little bit better than something newer up there because you've got so much new competition. And then, Houston and Fort Worth, as long as you can, weather the supply coming online over the next really year, I think you'll really benefit on the back end. So yeah, that's I think just some important things that we took away from this graph, and we'll get into more about kind of the population movement and growth coming ahead soon too.
Awesome. Yeah, so this is from Greg Willett, and basically, kind of, we read, we really pay attention to what he says. There's, as Hayden mentioned, a lot of this stuff is from, Real Page. We, listen to the CoStar folks as well. So there's a handful of folks we pay very, very close attention to. This is just, kind of, to Hayden's point about his pipeline drains, you're going to see rent growth could be pretty attractive coming up here soon. So okay, yeah, and so it's kind of, as we've mentioned a few times, DFW and Houston continue to lead the charge in terms of growth. This is just one thing that kind of supports that. So and it's a lot of the usual suspects that you see. So it's always we see a lot of this, but it's nice to see it from a few different places as well. So obviously we're big on DFW and Houston, so excited about that. But yeah, anything else you want to add, Hayden?
Yeah, I think that's pretty much it. Again, this actually came out this morning from Greg. So like Dustin said, we're big fans of his, and he puts out a lot of good data. But it kind of, as we were talking about too, just Dallas and Houston are so tight in terms of population growth and changes and so forth. The discrepancy in supply is something to just be aware of. And like a market like Austin, for example, is one of those that I think received a little bit too much hype, and then they overbuilt a little bit for the amount of people that were moving there. So they're dealing with some of those challenges too. So this is just something that we pay very close attention to, and we want to make sure we're getting into areas that we feel really, really strong about. And we agree with Greg 100%, where he says Dallas, Fort Worth, and Houston are, expected to be the winners on the backside of this once supply really falls off a cliff here. And like he states, they're almost twice as much as the next closest market. So tons and tons of people still moving here, and we do think there's going to be a lot of opportunity for sure. especially right now, because for anyone that didn't structure their debt properly a couple years ago, or didn't operate these properties very well and let things slip through the cracks, those cracks are getting expanded right now. And so if you can pick up good deals that are distressed, in our minds, this is a good time to do so. There's kind of two camps that we kind of see right now. Especially in Dallas, we like that, B class properties. We think those are interesting, especially if there's an element of distress to them. We think those could be really, really interesting opportunities. And then Houston, we're seeing, we still like the newer product down there a little bit more, just because the cost basis that you can get is really attractive. And then on top of that, we're starting to see some of those opportunities where they didn't manage them very well, and so that's become very interesting. And then on top of that, with the rents, temporarily softening due to the supply coming online, in our minds too, you've also got to consider, again, everything is submarket and property specific. So I want to put that disclaimer out there, but when rents overall are softening a little bit, it may not make sense to put $15,000 into a unit and update it if you can't get that premium for it. So you've always got to be conscious of, what's my ROI, what's my spend, does it make sense? And so in some cases, we're seeing some distressed opportunity where we wouldn't have to put money into those units because they are nice. But we can get a credible cost basis and be heavily discounted to some of the sales comps in the area. So we are seeing some of those opportunities, which we do find interesting. So those are kind of the two camps that we find very interesting. I think our next slide actually talks a little bit about this as well.
Yep. One thing I wanted to add too, just because, and we saw the same thing during COVID. Some people were like, "Oh, I'm pencils down," or whatever the case might be. And whether you buy or not, that's I think a separate discussion. But I don't think that and maybe they are, maybe they aren't. But the people that have been pencils down, the first half of this year or during COVID. Whether you buy or not, like I said, it's a separate question, but I think you should always be underwriting. You should always be, talking to property tax people, talking to insurance people, talking to loan brokers, and just kind of learning as much as you can. Because I think no one can really time the market. I think that we bought a deal in the middle of COVID, and we were like, we think this is going to be a really good deal. Feels really good. We really like the basis, yada yada. But the fact of the matter is, we thought it was a good deal, but it was hard to, a lot of people, it was hard to go to the bank. You had to wear a mask to go to the bank. And it was just it was a super just awkward time. And so, but point being that we don't think you should stop underwriting. You shouldn't stop talking to brokers or be pencils down. It's kind of, it'd be kind of like an athlete. It's like, oh, if I broke my arm, I'm not gonna I play baseball, but I'm not watching any more film. I'm not going to exercise the rest of my body. I'm just going to go over there and sit on the couch. And so, and I'm not saying other people, are doing that or not doing that, but I really, just feel like whether you buy or not, that's different. But you can always be learning and can always be just growing. So, you are, when you do see some deals that really look appealing, you've looked at a lot of deals, and so you kind of know, you're like, okay, well, those were pretty good, but this is really good. And if you were pencils down, you wouldn't have that necessarily that perspective. So this is kind of what Hayden was referring to on the last slide. So we're seeing some distress deals. We've seen some C-class distress deals, and frankly, the price per door just doesn't, it's not attractive enough, for us to dive in there. We've seen some B deals, very wide range of pricing, B deals in DFW right now. We've seen, anywhere from around 100 a door up to at least 160s, maybe north of that, Hayden. So we've seen a really, wide range. We've seen plenty, loan assumptions. I guess, there's two sides to every coin. If it's a loan assumption, they're, maybe if it wasn't operated well, then maybe they, do want to get out of it. But if they're operating well, they're not getting hurt by debt. And so I would think, yes, those might, be attractive right now, especially you can get a lower, rate and all that. I guess it depends on your entry cap, but I don't know if you may get a little bit of a discount, or, at least some discount, but I'm not sure, if they're not hurting, what's the incentive to, to drop the price there. We are seeing some newer builds that they're basically in a construction loan, in lease up or about to do lease up, and so some of those guys are stressed for sure. And we've just seen, we've seen operationally, when I started in multifamily, I started off, I got to my first deal in 2012 and then started, syndicated first deal in 2014. And, you throw up two-tone paint and vinyl floor and you got $150. And that was just, it was pretty easy. And now, there's a lot of, there's headwinds and all that. And you really have to operate, have to really, have your stuff together. And so anyways, some people have gotten into some deals, and especially, it's very disproportionate, like those tougher parts of town, the older C-class deals, not to pick on them so much, but those they're tougher to operate in. When I first started out, that's where I bought too, because that's, what you're, that's kind of just what you did. So we bought C-class deals, and man, they can be tough for sure, especially in a more difficult environment where you're seeing lower occupancies, more delinquency, more concessions and things like that. That can be especially difficult to operate in. So Hayden, anything else you want to add?
Yeah, I'll just kind of go over the timeline of events of kind of what we've seen over the last year. Because obviously with the Fed aggressively hiking rates, it's kind of forced everybody to feel the effects of it. And the initial thing that we saw was the first deals that started popping up were the ones in really rough areas. That was number one to go. So obviously, back to Dustin's point, you can't change your area. And, we absolutely saw the results of that because those were the first deals to pop up. So rough area deals were the first to go. Then the second was older deals. Started to see a lot of older deals, again, in, so sorts of areas. And, just again, opportunities we weren't willing to pursue because, we perceived them to be too much risk. And so that was kind of the next stage that we entered into. The third stage we saw, just for whatever reason, if somebody had to sell, if they had a fund coming due or they had a loan coming due or whatever, the kind of necessity sales, we started to see those. Or people that did well over the last 8-10 years, and they're like the deal we closed on about a month ago, they were closing out a fund, just needed to let go. Their fund had done well. They could take a little bit of a loss on a deal, and so started to see those. Now we're getting into this cycle of we're seeing those people that tried to hold on as long as they could, and now they can't. So that's kind of where we're at right now. We're seeing that those sorts of opportunities all the way up the spectrum, from A's all the way down to C's. Again, depending on how they operated, how they structured their debt, how proactive they were on their various operations. And the big question is, well, how long do we see these opportunities for? And that's where everybody wishes we had a crystal ball. And I have no idea how long we're going to see these opportunities, because we are seeing, like the slide says, there 20 to 30% discounts. I mean, in some cases, we're seeing, for example, a 30% discount on a $200,000 door deal is $60,000 off that basis from what it would have traded, or those sales comps in that area did trade a year or two ago. That's huge. So we are seeing those opportunities now, and the question is, how long is this going to last? And I wish we could tell you. I wish we had those answers for everybody's sake, but unfortunately, we don't. A lot of that is largely in the hands of Jerome Powell right now. So, we'll see how long interest rates remain elevated. That's going to drive a lot of this. So. So we'll see. There's just so many factors in the economy right now that are going to drive his decisions too. I can tell you, on the inflation front, it looks like he is winning the battle. And then, I know housing has kind of been their last thing that they've been trying to fight. And, we're seeing it firsthand on the ground that, it's working. It's absolutely working. So, the markets all across Texas, the rents are just softening. And so, I think the battle against inflation is working. Now, the next question is just how long do these rates remain elevated? So, in our minds, and again, who knows what's going to happen, but if rates do come back down, because the real estate market is gridlocked right now. Nobody wants to sell. Buyers don't want to pay what sellers want. Sellers don't want what buyers are willing to pay. Just look at the single family market. Most people, you don't want to sell your 3% loan and get into a 6 or 7% loan. It's just nobody wants to do it. And so there's no inventory on the market. You're still having people move and need to buy places, but there's just nothing there. So that's kept, on the single family front, that's kept prices up and from dropping a whole lot. So everything's just gridlocked right now. And, when interest rates do come back down, I think that's going to unlock the market just as a whole. I think we're going to see another 21, 22 period where, COVID was very similar. It's different circumstances, but the same thing was resulted, which was transaction volume was very, very low. And that's where we're at in the multifamily side right now. We've got record low transaction volumes. I've seen numerous reports about all the major brokerages where their revenue figures are just almost hard to believe, where they're at like 5% of what their revenue was last year. Just ridiculous figures. So there's no transaction volume going on, and that's largely due to the interest rates. And so when those do come down, I think that's going to unlock a lot. And it's going to be interesting to see what activity and pricing does when that does happen.
Yeah. Appreciate you guys, logging in and all that. It's great to see a lot of familiar faces and all that. It just kind of reiterate, you were building up a pretty nice sized, portfolio in Houston. It's 2,000 year product. Everything's called the Henry. At something. So we have the Henry at Liberty Hills, the Henry at Woodland Hills, the Henry at Deerbrook, the Henry at Jones Road, and the Henry at Rosenberg. So anyways, we're excited about everything that's kind of going on down there. And then we're looking to build a portfolio in DFW as well. We don't have to buy. We don't have a lot of overhead. We don't have tons of employees and staff and all that other stuff. So anyways, we're pretty nimble and we're able to, our goal, just to, kind of put, our goal's been, 4 deals a year, one a quarter. And we've been averaging, 2 per year. So, we do want to grow, but we're not willing to, sacrifice the type of deal, type of opportunity, for just adding another another deal on. So we just want to make sure we're getting into the right deals, and then we want to make sure we can operate them. So yeah, like Hayden had mentioned, it's one thing to buy, and it's another thing to actually be able to operate. We're very fortunate. We have a really good team around us. We have a lot of processes. We have Excel spreadsheets that there's a handful of tabs our managers have to fill out before our Monday meetings, and then we have the same thing for our asset managers. So we have lots of processes and lots of just checks and balances in place to kind of keep everything on the right track. But and then yeah, just looking to build a portfolio also in DFW. We're betting on those two metros, and just want to make sure we get in right spots of town and right deals. So Hayden, anything else you want to kind of mention?
Yeah, I'll just summarize. Just in general, I think overall we're all still active in the marketplace. We just closed a deal about a month ago, and we're actively offering on deals too. So we still believe in Texas. We still believe in apartments 100%. It's what we live and breathe every day. So we love being able to come in and transform these communities and enhance the homes for our residents. So we still believe that it's a great place to be, a great place to invest. There are definitely near-term challenges, but I think that'll also provide some very, very interesting opportunities. How long those opportunities last, we have no idea. So, we're trying to get some as they come. The window may be long, it may be short. We're not 100%. There's just a lot of variables that affect that, but overall, I think now is an interesting time to try and pick up some good, well-located opportunities. And I think, a couple of years from now, especially, it'll be a wise choice, just because of, just when you look at the fundamentals, where you have tons of people still moving here, you're going to have an imbalance of supply and demand in 24, 25. And you've got a very affordable cost of living, especially as you compare it to other parts of the country, and business friendly, a governor trying to advocate for homeowners and its population, and attract new businesses to move here. So a lot of good, I think, is still in store for Texas, and we're very bullish overall. And yeah, just really appreciate everybody spending your evening with us, and letting us chat with you guys for an hour. And yeah, we're open to, if anybody has some questions. We have a couple minutes if you guys here we go.
So Kale asked, did we make any material changes to the insurance policies to maintain similar cost structure? No, we didn't. The lenders are very conservative, just in general on insurance. So we have to do what's in the loan docs, and basically what they want. So that did not change. Obviously, once we bought the property, that the loan docs did not change. So we had to adhere to the same everything. So yeah, no material changes there. We just honestly, we called a lot of people, talked to a lot of people. Fortunately, we've been doing this for a little while, and we networked around a lot, and so able to find a few pretty good carriers. I think it helped a lot that we were buying newer product too. If it was older product, just in general with older product, you have fewer, there's fewer people that will insure that, and when there's less competition, prices go up.
Yeah, each decade you go back, the amount of carriers essentially falls off exponentially. So 2000s and newer, you'll find a lot. 90s and newer, you find a little less. 80s and newer, you find significantly less. 70s and 60s and newer, then it drops off quite a bit. A lot of insurance carriers won't touch 60s and 70s product, and that's where they're having to layer. It gets really expensive when you have to layer coverage. And a lot of people are out there having to do that with multiple companies, and that's just killing them. So, having stuff, especially that's 2000s and newer, even 90s and newer, is a good place to play. Helps out a ton on the insurance side, and not in flood zones. We don't touch flood zones.
And then Pat and Adrian, good seeing you guys Saturday, by the way. But have you experienced much variation in occupancy? I'd say we have overall we have lower occupancy. We've had to offer some concessions. Some of that's been due to there was a deal that new supply, and so they were offering deeper concessions, and so we had to at least kind of somewhat compete with them. Once they fill up, I think we'll be able to kind of pull back, but overall we're seeing a little lower occupancies. I'd say when rents were popping and all that, everything was 95 plus, and if you weren't, then there's really something wrong. Right now in DFW and Houston, most everything's kind of, I'd say, in that lower 90s range. Depends on the submarket. Some submarkets are a little better than others, but you're probably in lower 90s all the way. So
one thing too that's interesting. So again, why we think 24, 25 is going to be really good for multifamily is so for example, I toured a deal over in Katy, Texas, west side of Houston, lots and lots of building going on. It was a pros deal. So pros is an alliance product, and it's nice workforce housing sort of thing. It's kind of bare bones amenities, but it's a nice place to live sort of product. And what they've been doing, and they're still, the lease up velocity is still really good. And what they do, they'll run a month free for about 8 or 9 months till they hit stabilization, and they kill it entirely. So the markets where you are seeing new supply come on, you're having similar stuff like that. And I think that's what you're going to have to deal with for that period of time of stabilization. But the good thing is a lot of these builders and so forth, they've got it down to a science. And so as soon as they hit stabilization, they pull that off, and that'll help that submarket overall too. So again, I think for any submarket in general that is dealing with more new supply coming online, I think as long as you can weather some muted rent growth, and you're staying on top of where your rents are so that you can stay competitive, that's another big thing. If you set your market rents and forget it, you might be in trouble. You've got to reassess those things, watch your supply pipeline, watch what your comps, not only new supply, but also your existing competitors in that property. Every week you should be doing a market survey, trying to figure out what specials and where the rents are. That's one of the documents we task all of our managers with every Monday. Is when you submit, we have a report, a custom report that Dustin referenced. It's called the WMR, Weekly Management Report. Along with that, you have to attach your market survey every single week, so we can know what are our competitors doing, where are their rents, what specials are they running. You have to stay on top of that.
And then Richard asked, presume you mandate renters insurance, and then basically who kind of keeps up with that. So we like to work kind of with so we do have third-party management, but we work with another company that handles the renters insurance. Just for your point, Richard, that it's just one less thing they have to keep up with. We don't want them looking at tons and tons of things. We really want them focused on collections and leasing, and then on the maintenance side, obviously maintenance, but so we really want them focused as much as possible. We just like us, we like to stay in our swim lane. We want them to stay in their swim lane too, so they can be excellent at what they do. But Yeah, and just another kind of point. So we have a graphic designer that we work with, and so we don't want the managers, we want the same level of graphics, throughout. So kind of the same thing. And then he actually handles our social media as well. Just so we can have that streamlined look to where, if you go from property to property, you don't see, lots of variation or anything like that.
Yeah, and just to follow up too with your question, Richard. Yeah, if you don't keep up with that, absolutely it could affect you. And especially when like you get a hoarder tenant or somebody that damages and tears up your unit. If they don't have renter's insurance, that's not fun to deal with. So there's a lot of different companies out there that can do that for you and integrate with your property management system. Wilson Peak has a partnership with Asset Living just for that. And so it's automatic keeping up with that renewals and as people move in, move out. And then what's the other one? Foxen is another one.
Yeah.
They're same sort of thing. The guy that started Foxen, actually, it's Foxen. He was an owner as well. I can't remember what group, but he had a lot of units. Same sort of thing. He had residents that would just trash these units and didn't carry renter's insurance or anything, and he was out all that money. And so that's where he started Foxen, was this third-party system that integrates with property management companies so that they keep up with who's got renter's insurance, who doesn't, who do we need to remind to get coverage, that sort of thing. So there's definitely options out there to make the on-site staff's life easier on that front.
We could probably maybe do one more, but then we gotta hop off. Okay, well, cool. Unless there's anything else, yeah, appreciate you guys hopping on. And if you came a little bit late, we'll send out a recording and all that too. So but yeah, just great to see everyone. Great to see a lot of familiar faces. And yeah, we'll talk soon, and hope everybody has a good night. See ya.